So let's be honest. If you really want to turn, say, 75,000 pounds into a million, you're probably not going to get there just by buying a standard index fund and waiting around. You need something else. You need what investors call alpha, those massive outsized returns. But where do you even find that? Well, here's the thing. This alpha, these game-changing returns, they're almost never found in the safe, big, well-known stocks everyone talks about. Nope. They're usually hiding in the corners of the market, in speculative, high-risk assets that most people have completely written off as junk. You find them in the garbage. And that's the big question, isn't it? If you're going to go digging through the financial trash heap, looking for treasure, how do you do it without accidentally blowing up your entire portfolio? How do you handle that immense risk that comes with hunting for exponential growth? Well, it turns out there's a system for that. Okay, so to make this work, you have to be disciplined. You need to build a specific walled-off section of your portfolio just for these kinds of high-risk bets. We're going to call it the speculative tier. I want you to think of it like this. Your stable, anchor stocks, maybe like a SoFi, and your blue chips, like AMD. They all live on the main floors of the house. They're solid, they're reliable, they're designed to be around for decades. But today, we're going down to the basement. This is where we keep the experiments, the long shots, and yeah, the potential lottery tickets. So, this lays out the 3 bets that are currently living in my portfolio's basement. And look, each one is here for a very different reason, and each one carries a very real chance of going completely to zero. We've got BigBear.ai, Iris Energy, and SES AI. Let's break down why each one is even in here. All right, first up, BigBear.ai. The idea here is pretty simple. It's basically Palantir Light. They use AI to help the US military make better, faster decisions. Now, the stock has been absolutely hammered, so much so that the market is pretty much pricing it for bankruptcy. And that's the key. This is not a bet on them becoming the next $100 billion giant. It's a bet that they simply don't go bankrupt. If they can just survive and grab even a tiny piece of the defense AI market, the upside could be, well, violent. Next up is Iris Energy. Now, this company used to just be a Bitcoin miner, which, as you know, is incredibly volatile. But the real bet here has nothing to do with Bitcoin. It's all about their pivot. See, Iris Energy has these massive data centers with just huge amounts of power, and they're shifting that power away from mining crypto and towards training AI models. Why is that a big deal? Because the giant tech companies, the hyperscalers, they are absolutely desperate for one thing right now: power. IREN has it. So this is a bet that the market will stop seeing it as a risky crypto miner and start revaluing it as a crucial piece of AI infrastructure. And finally, we get to the smallest and by far the riskiest bet of them all, SESAI. This is a pure science project risk. They're working on next-generation lithium metal batteries. The connection to our theme is obvious. AI needs a colossal amount of energy, and our grid needs way better ways to store it. Now, if their tech actually works, it could literally change the world. But if it doesn't, this stock goes straight to zero. It is a completely binary outcome, a true venture capital-style bet. Okay, holding these kinds of stocks can feel a bit like juggling chainsaws. It's dangerous, so you absolutely need a safety net. This portfolio uses a very deliberate 2-part system to manage all this risk and, avoid blowing everything up. The first pillar is probably the single most important rule in high-risk investing: strict, disciplined position sizing. This is all about knowing your limits and rigorously controlling your financial exposure before you even think about placing a bet. And this chart just illustrates that core safety rule perfectly. You can see the entire speculative tier, all 3 of those crazy high-risk stocks combined, makes up only 15% of the total portfolio. The other 85% is sitting in those much more stable anchors and blue chips. What does that mean? It means even if the entire basement floods and goes to zero, the house is still standing. Now, that 15% isn't just some abstract number. In this specific portfolio, it represents a real, tangible sum of about 11,500 pounds. This is an amount the investor has to be, and is, mentally prepared to lose completely. Here's a good gut check. If that number makes you feel sick to your stomach, your position size is way too big. But just sizing your positions correctly isn't enough. The second pillar is having a disciplined, repeatable process for constantly stress testing your own ideas. You have to actively and ruthlessly try to prove yourself wrong. I call this the bear case interrogation. So I use an AI agent that I've named Mary Jane, and I don't ask her for price targets or good news. I tell her to act like a ruthless short seller and answer one question. What is the single biggest risk that could kill my investment right now? The whole goal is to find every single reason the company could fail. So let's put this into practice. Let's take that system and apply it directly to our first stock, BigBear.ai. We've heard the bull case, the whole Palantir light story. But what's the other side? What could actually kill this company and send the stock to zero? And here it is, the brutal, honest answer from the interrogation. The system flagged three huge risks. First, cash burn. The company is not profitable. In fact, it's losing money every single quarter. Second, convertible debt. They have some really toxic financing that could dilute shareholders into oblivion. And third, what we call lumpy revenue. Winning a big military contract is great, but that money doesn't come in a smooth, predictable stream. So here's the crucial part. This systematic process leads you to a clear, logical decision, not an emotional one. The verdict for Big Bear? Hold the position we have, but absolutely do not add a single penny more. The risk is just too high right now. It's officially a show-me stock. It has to show me 1/4 of positive cash flow before any more money gets allocated to it. Simple as that. And all of this brings us to the final and I think the most important takeaway from this whole thing. When you combine strict position sizing with this kind of systematic interrogation, you transform a really dangerous activity into a calculated one. You stop gambling and you start making what we call asymmetric bets. Here's the difference right here. Gambling is all about emotion and hype. The risk is totally undefined, and a bad run can be absolutely catastrophic. Asymmetric betting is the exact opposite. It's based on a system. Your downside is strictly defined, and most importantly, it's survivable. And your big decisions are driven by the cold, hard data from your interrogation, not by fear or greed. And here's the entire framework in 4 simple steps. 1, find a potential home run, something with massive upside. 2, size your bet so that if you strike out, it doesn't end your game. 3, actively try to destroy your own argument to find the real risks. And 4, make a clear decision based on that data. It's a repeatable process for managing the unmanageable. So that really just leaves us with one final thought. We've walked through one specific system for handling the most volatile part of a portfolio, but the principles here are universal. So the real question you should ask yourself is this: what's your system? How do you protect yourself from your own emotions when you're dealing with those high-risk, high-reward ideas?